Alright, welcome to another run through of the top 5 charts of the week. So the top 5 charts of the week is just a selection of some of the standout charts across the blog, social media that I've put out there, and designed to basically bring them all together and let you enjoy the insights that they provide. And the purpose of this video is to go through and just add a little bit of extra comments and context around them. So without any further fluffing around, let's get into it. First one, Global Equity Def Cross Breadth, or Def Watch, it's called the chart. Now the red line here is looking at the 70 countries that we monitor. So first of all, what is a Def Cross? Def Cross is when the 50-day moving average trades below the 200-day moving average. Now why would that be something that you'd want to look at, or why would it be something that would be sinister, as the name kind of suggests? Well, the 50-day moving average is, I think it's a good way of characterizing the shorter term direction of price. So it kind of smooths out the noise a little bit and gives you a characterization of where the price is generally been. And the 200-day provides a longer term generalization of where price has been. And so the reason why you'd look at 50-day versus 200-day, as we're looking at here, versus just 1 day, or just the latest price versus 200-day, is that the signal that you'd get from price versus 200-day would be a lot choppier. So it's pretty much just a smoothed way of looking at whether price is generally above or below its 200-day moving average. And let's just think about that. If price is below where the price, if price is generally now below where it's been generally over the last year, well, we can say that the market is going down, or at least has gone down by a material amount. And 200-day moving average is a pretty good indication of where the trend is. And so if prices dropped materially and in a smoothed way below the 200-day moving average for the longer term trend, then it's fair to say that probably most of the time that market that you're looking at is in a downtrend. I mean, it's probably about as good as any mechanical rule-based description of what's an uptrend or a downtrend. You look at a chart and you can see pretty much instantly whether something's in an uptrend or downtrend. But actually, translating that visual interpretation into a mechanical rule is another thing, and that's what this does. So back to the chart, if you look at the red line here, it's looking at the 70 countries that we monitor, and it's saying how many of these countries, as a percentage, expressed as a percentage, are in a def cross, so where their 50-day is trading below their 200-day. And as of the latest run of the model, it's 64%, or 45 out of 70. So that's the majority of countries are in a def cross. And astute observers would look at this line here, which is the MSCI All Countries World Index. I think US is about 50% or close to 50% of that index, and US has been sort of just holding up all right. So obviously it's offshore that's driving this this spike here. And if you look at the stats that I've listed here, within developed markets, it's only 48% are in def cross mode versus 64% at the headline. And yet if you look at frontier markets and emerging markets, they're both just over 70% of those ones. So it's pretty clear what's going on here. It's basically, this is being driven by emerging markets. And the reason why that would be of any interest, or any meaningful sort of implications for this, would be that the stress obviously developing in emerging markets, and that's being driven by Fed tightening, interest rate hikes and quantitative tightening, and US dollar strength. And I don't think that's over yet. there's a bit more water to go under the bridge. We've seen it in the past when the Fed embarks on material amount of tightening and you get material amount of US dollar strength. I think we still see more US dollar strength from here. So, you know, there's if you were looking at this line as a signal, I would say that there's been a lot of false signals across time. So I guess false signals as in it spikes in a bear market or a deeper correction doesn't take hold. I'd say that it's probably more of a warning sign this time, just given the stresses in an EM, and if it these things can end up being nothing but a storm in a teacup, but then they can spiral out of control as well. So not to be extremely pessimistic, and I wouldn't definitely would not call myself a perma bear. I just look at the data and try and make my interpretations as I see them. Anyway, moving on to the next one. US cyclicals versus defensives. So actually, this is another one worth mentioning. I haven't got the chart here today, but globally we've actually seen a bit of a rotation underway between cyclicals and defensives. So, you kind of expect that because there's pretty much two ways that an extreme run up in this cyclicals versus defensive line can actually unwind. So the first one would be a bearish rotation, which is the typical way that it would unwind, and that's the market rolls over and cyclical stocks fall further, or say defensive stocks fall less than cyclical stocks. So um, it's a bearish rotation. The bullish rotation would be if you just get a leadership change in the market continues to go up or sideways sort of thing, but you just have a rotation, defensive start to outperform. And the reason why that matters and why this chart matters is because if you get a bearish rotation here that unwinds this kind of extreme performance that we've seen, it's going to mean meaningful downside risk here. So look, that last big leg of the bull market that was clearly driven by cyclicals, it was great at the time, but question mark really there is around whether we see a bit of payback. Sip of coffee there because it's 7 a.m. in the morning right here. Now, number 3, Fed Loan Officer Survey and credit growth. Now, this one's an interesting chart for quite a few reasons actually. So the blue line here is US commercial and industrial loan growth, and the red line is the commercial and industrial lending standards from the Fed Loan Officer Survey, updated to the latest, which is out last week. And it's on the left hand side, shown inverted with a 10-month lead or pushed forward 10 months. So the conclusion or the main takeaway from this chart is that loan growth is likely to pick up from here. And I actually talked about this in a report that I sent out to clients last week, where you've got this interesting easing of lending standards, which it's pointing to this tick up in credit growth. You've also got a couple of leading indicators of capex or capital expenditure growth on the upturn as well. And I think that that capex growth, we haven't even seen the best of that yet. I think that we're going to see a strong upturn in capex growth over the coming quarters. And once the midterms are over with, if Trump comes through and does some sort of infrastructure spending arrangement, fiscal power behind that's obviously quite muted unless you decide to go deeper into deficit. But you could see this scenario of a US investment boom unfolding, which I think is quite an interesting thing, and something that I'm going to be doing more work on. Anyway, yeah, the chart shows an expected uptick in credit growth, and it's worth noting the economic sense of it, because it's one thing plotting two lines against each other, it's another thing thinking about whether they actually make sense. And if lending standards are easing, that generally tends to make borrowing a bit easier. So, it makes sense from that point of view. The other thing is it's quite a pro-cyclical indicator. So as economic conditions improve, they usually ease lending standards more. And as economic conditions deteriorate, they tend to tighten up conditions. And that's why, it can be quite a good warning sign as well. But at the moment, no warning signs here. If anything, it's just saying onwards and upwards. With that note, onwards to number 4. So this is a chart of the Economic Policy Uncertainty Index, and this is a indicator. So if you can see that website there, policyuncertainty.com, go to that website. They'll give you a much more detailed and technical explanation. But basically, it looks at it's an algorithm, reads news articles and tells you what level of policy uncertainty there is based on the appearance of certain words. And for China, it is spiking, and it makes a lot of sense because you've got growth softening there, of which I've talked about at length previously. You've got the trade war, and you've got the prospect of policy changes there, so more monetary and fiscal stimulus probably. So as scary as this chart kind of looks, as the macroeconomic outlook continues to soften in China, the odds of a actual positive surprise coming out of this, i.e., more stimulus, starts to rise, and that will be very meaningful for commodities and emerging markets. But in the meantime, probably need to see a little bit more softening before they actually take more meaningful or decisive action. And the last one, Decisive. Let's talk about Decisive. Gold is at a decisive point here. At this point where it is right now, it's broken down for that little short-term upward trend rather, and this overhead resistance area has proven unbreakable, impassable for now. And it failed to break out there. It failed to break out of that downturn trend channel, if you can kind of imagine it there as well. Then you've got a few other headwinds here, stronger US dollar, rising real yields. So it makes sense that you'd see some capitulation, and that's what we're seeing in the flows there. Futures positioning is pretty similar as well. Straight up capitulation by investors. And, that can create one of two scenarios. The first one is that you look at it as a contrarian indicator and you get a short-term bounce. And I think, the odds of a short-term bounce are pretty decent. But I would say, given those headwinds, it's probably going to be more of a short-term bounce, as in like what happened in this period here, 2013. Short-term bounce, but the bearish headwinds prevail. The other scenario is where capitulation leads to a downward spiral. And I will leave it to you to think about the most likely scenario there. Anyway, that is the 5 charts of the week with a bit of extra comments and context. If you want to receive this email in your box, just I'll put the link to subscribe in the video description, or otherwise just visit topdowncharts.com. And if you like this video, just go ahead and subscribe to the YouTube channel because there will be more of them.